if you take a look at what investors are missing, of course, a lot of people concerned that you're just not getting value because of where spreads are right now. What do you tell them?
Look, I think a lot of people are just too focused on the spread and not looking at the absolute dollar price of the index, which is still below par, so you do have some convexity, and the absolute yield. And if you think about it, at these higher rates for longer, which is what our view is, you're going to compound that interest, and from a default standpoint, that mitigates a lot of the recoveries. So we like credit right now. We think it's a higher resting heart rate for rates. It was Albert Einstein said, compounding is the eighth wonder of the world, and I think you're just going to get that continued reinvestment of the income for a while now.
Now, Chris, I don't want to pretend that everything out there is rosy. I want to also pay some attention to what's starting to weaken in the credit spectrum because we are seeing defaults in part of the market.
For sure. You're seeing the economy slow. All the increased, Fed rate hikes is working. It's slowing the economy. But we are not envisioning a big spike of defaults. It's not like previous recessions where there's a big shock on the system. And if you look at across all the different sectors we've seen, you've almost been in kind of a rolling recession where some businesses have been in a rut for 3 years now and are just bottoming and coming out. And then there's some industries that are actually starting to see slowing and continuing to go in. So we do envision increased defaults, increased downgrades. However, it's not sort of Armageddon in terms of a big spike of defaults.
But even if you don't see an Armageddon coming, fair point, what do you think about investors who are piling into riskier credits right now? Do you think some of them might be avoiding some of the risks out there?
For sure. And if you look at the market and the market construct, the incentives to take risks have been stripped out of the market, particularly in the liquid markets. If you look at a big part of the loan market, CLOs, they really can't buy a lot of triple Cs. Big part of the high yield market is insurance companies that really can't buy below double B, let alone single B type risk. So the incentives have been pulled out. There's more and more dispersion in the market. And so, as I sort of mentioned, people are focused on spreads, but there's a lot of dispersion in that. So it's a credit picking market. I'm not saying you should go buy all lower rated triple C risk, but there's a lot of interesting opportunities if you can underwrite and differentiate yourself on some of that lower rated risk.
Chris, to the extent that you see dispersion, where are the most mispriced opportunities worth picking at right now?
Well, right now, and as we mentioned in our letter, you're just seeing the CLO machines just start again, and you're seeing a ton of resets happening. And as a result, people are trying to bring their triple C baskets down. And so you're seeing a lot of motivated sellers in triple C loans right now today. And there's a lot of good companies, or there's certain industries where the ratings for those industries are naturally going to get triple C, whether it be insurance brokerage or software, where there are not a lot of hard assets, where the rating agencies often penalize the recurring cash flows of those businesses.
Motivated sellers, Chris, or forced sellers? Is there a reason some people are sitting here offloading at this point?
Yeah, it's more motivated. I do think when there is misses, there's a sell first, ask questions later when they're missing on the earnings. We're not seeing like dramatic forced selling. I would say that when things are going into a default or things are really in dire, you see some more forced selling. But right now, it's not, Armageddon forced selling right now.
I'm really curious about why people are tapping debt markets at this point. You saw just a tremendous boom at the beginning of the year of investment grade. Then you saw the junk bonds follow. Then you also saw a wave of issuance when it came to leverage finance pertaining to private equity firms. We have a story out right now about how private equity just won't stop gorging on debt to pay their investors, looking at dividend recaps. Would you be a buyer of that kind of issuance?
It depends. Look, I think you're seeing a lot of flows, as you sort of highlighted in the high yield HYG inflows and from retail. You're seeing flows back into credit. You're at the point where I think you're more consensus around a softer landing, not a deep, dark recession. There's a little bit more certainty that inflation is under control. So capital's coming into the market. There's been a lack of M&A, which is why you're seeing an increase in sort of dividend deals from private equity sponsors. So I'm okay lending and participating in some of these dividend transactions, particularly if they're businesses we know, if they're management teams we know, that they've hit our numbers for the last 5 years or 3 years that we've been in those loans. So I don't get too spooked by the increase of private equity transactions taking capital back. And in many cases, a lot of these private equity firms have still a ton of capital in these businesses, so you're still aligned. But I think you have to just be wary. It's about the right ones leaning in and avoiding the mistakes. I think right now it's about keeping it simple, not reaching for return or yield, understanding the businesses that you're lending to, picking the right sectors, avoiding the secular decliners. There'll be a time to go into complexity. There'll be a time to go into stress. We just don't think that's the time right now.
Real quickly here, if you had a choice between the broadly syndicated market or the private credit market at this point, seeing the deals that are coming to surface now, what do you choose?
Well, look, I mean, private credit market is a big market. That includes direct lending, that includes junior debt, that includes all asset-based finance, and it also includes some capital solutions. Right now, we're seeing a really interesting opportunity in asset-based finance. A lot of portfolios of loans coming out of the banks, a lot of collateral-backed cash flows that seem to be less correlated with what you're seeing in sort of fundamental corporate macro risk. So we're leaning towards sort of that asset-based finance right now. We're leaning towards a little bit of the capital solutions where you can be a little bespoke, you can construct your own capital structure.